Tax efficient withdrawals in retirement. Man, what in the world is tax efficient in retirement? I thought when you moved into retirement, you just went right into a lower tax bracket and the efficiency happened all on its own. Well, that's not the case. And welcome to Elements in Focus. If you are new to our video series, this is where we are covering our 5 critical elements, breaking those down topic by topic, week by week. And I've got Grant Soliven, our wonderful partner and financial advisor, works in our Indian Anderson office. Actually, he's been all over the place, all across all of our offices in his 10 years of tenure with FEG. So welcome, Grant. Let's unpack years and years and years of knowledge of actually talking through tax efficient withdrawals and retirement and just debunk some of the myths of, for lack of a better word, the junk people have been fed.
Yeah, for so long, and thanks, Aaron, for the introduction. I will successfully do years of knowledge in about 2 minutes. So hold on to your chairs, ladies and gentlemen. It's gonna be a wild ride. But I think that's what Aaron's really trying to get at right now is that little white lie that has been just permeated into our society of, oh, I'll make less money in retirement. That's just how it goes. Well, ask any of your peers that are currently enjoying your life after work, which we call retirement, ask them how that's going. 9 times out of 10, they're going to tell you it isn't going well, meaning they're often at times paying just as much or more income tax now than they ever have before. So even with the One Big Beautiful Bill Act changing some of that direction, meaning elongating some of the runway for good tax planning, there's still a couple things you need to do and understand when it comes to tax efficient withdrawals and retirement. So what's that number one? Well, the number one that we always tell our families is not all of your assets are created equal. I know that sounds really funky and maybe not, maybe a little taboo for the conversation today, but realistically, it's not. You have tax deferred assets. So that's traditional 401k, or sorry, traditional IRA, traditional 401k. You have tax free assets, which are your Roth dollars. And you have taxable assets, which are just about everything else. So real estate, brokerage account assets. Think about interest from banks and CDs. And really, when you look at all three of these, one thing we recommend with families is lay them out. Figure out how much of your resources are in each bucket, and then start looking at what we call your mailbox checks. So, what's your expected income? Where's it coming from? Social Security, pensions, annuities. Build this tax map out for yourself and figure out, okay, just where are all my dollars coming? And then ask yourself, based on my lifestyle, what sources outside of my paychecks, my mailbox checks, if you will, are going to come from these other resources. And then the next step is once you have the map drawn out, start figuring out how you're going to withdraw. What's your withdrawal strategy? So traditionally, we like to, based on certain tax considerations and based on your tax brackets, marginal versus kind of your effective or average rate, and that's another video just to be had in itself. Once you understand those data points, well, then you want to take as much tax deferred money as you can out in the tax bracket you're stuck in, and then start managing distributions from your other buckets. That makes things very efficient. For those of us that live in the 12% tax bracket, capital gains in retirement, if you take out those and qualified dividends and you remain in that 12% bracket, that could mean a 0% federal tax bill, right? So there's all kinds of ways you want to approach this strategy based on that tax map we talked about earlier. Another big one, let's just say you're carrying a ton of tax deferred money because you did exactly what you were told for 10, 20, 30 years, and you saved money tax deferred into your 401k plan, and you got an extra tax little kick. You saved some money along the way, but now Uncle Sam's come knocking, and those dollars are now taxable on distribution or upon distribution. Well, if we don't take care of that bucket, your taxes could escalate over time. Grant, how's that possible? What do you mean by that? Well, there's this little thing called required minimum distribution. And every year at your RMD age, whether it be 70, 73, 75, depending on your birthdays, every year you age, they're going to take more. And here's the cool part. As you make more money, they take more. So you see this kind of increasing problem over time. Yeah, that's what RMDs do to families. And if we don't address that situation early on, it could lead to some pain. So we recommend Roth conversions. So with that tax map, with your distribution strategy, if there's wiggle room in the tax bracket you're stuck in, Can you do Roth conversions to mitigate some of that future pain? And then naturally, finally, coordinate all of this. So coordinate your RMDs, coordinate your capital gains, coordinate your interest income. Look at what your tax strategy is going to create. And don't forget the extra tax that almost everyone forgets about, and that is IRMA. So Medicare, those of you enjoying Medicare right now, there's an extra tax if you make too much money in distributions. So really looking at your tax map, understanding how these coordinate and play out, right? Knowing the pieces of the pie. One of our advisors, Darren Hardesty, probably said this best at a big function we had for our families called the Thirdly recently. And he said that those who understand the rules of the game are the most successful in the game no matter their talent. And he's absolutely right. Understanding the rules of this tax game are critical. So if you're going to have tax efficient distribution, you have to know how, first and foremost, what your tax map is. Then what are your goals you're trying to accomplish? How is our distribution strategy, say that 3 times fast, going to work in this situation? And then how do we coordinate and create buckets of money that will help us as we age successfully and use our dollars for our future? Now, if you've written all that down and you take a step back and your hair's on fire and you're going, holy mackerel, how does one manage this? This is where we come in. And so this is Financial Enhancement Group's bread and butter. This is what we do. I wish, Aaron, so much that we could show the amount of extra return we can create with families over time by being tax efficient. That's something we just aren't able to provide. But when we look at our financial planning software and show our families what all these strategies can do, it's often substantial. And so if you're looking for a team to help you do this, we'd love to have that conversation. Aaron, is there anything I've missed in this discussion that you'd like to add?
No, I mean, you covered a lot in that small amount of time that you talked about. One other thing, and you may have covered it, but it is just making sure that we pay attention not only today with the tax efficient withdrawal strategy, but also in the future, because what we find is there's a penalty that happens when a spouse passes away. So if you don't pay attention to making sure you're being tax efficient and doing tax efficient planning, a lot of times we find the most pain comes when you don't do proper planning around that and a spouse passes away and your brackets get cut in half from a marginal bracket standpoint. So there's 100% rhyme and reason why we do tax planning, why we talk about tax efficient withdrawals, and why we not only think about taxes today, but tomorrow, because things change, life happens, and if you don't plan today well, it can create headaches tomorrow. So that's all I wanted to add.
Absolutely. Hey, I heard a family tell me this recently and I loved it and I told them I'd steal it. So here's the opportunity. He told me, Grant, it feels like tax planning is a full contact sport and it's a long game. Absolutely it is. Reminds me of rugby. You're getting hit the whole
Yeah.
way, but you can find a way to get an advantage and you're on that clock for a long period of time. So Aaron, you're absolutely right. So folks, if you're looking for that kind of guidance, please give us a call, 800-928-4001. We'd love to stand and connect with you. For those of you that work with Financial Enhancement Group and our talented advisory team, you're probably already in the midst of your tax planning meetings. So this will be a redundant story for you. But for those of you that are new to this and want to engage, please give us a call, schedule a complimentary meeting. This is where the winning is done. So a lot of good books talk about getting those inches right on the field. This is that. So love to have that conversation with you. You can also find a lot of other great content that Aaron and other advisors have done at yourlifeafterwork.com. But my friends, thank you for being with us and letting us make taxes exciting. And we look forward to seeing you in the future. Take care.